Hello, everyone. Welcome to our McGuireWoods webinar, DSO Regulatory Transactions Fitting the Mold. My name is Anna Timmerman, and I'm a healthcare partner at McGuireWoods in Chicago, and I'm joined today by my colleague Justin Knapp from our Charlotte office. Justin and I focus our practice heavily in the dental space, and we are excited to be presenting this webinar to you today. So we'll start out by just really briefly going through our agenda. And we're going to start out with just briefly talking about the legal structuring considerations and the dental practice transaction structures. Ultimately, we want to put definitely a regulatory spin on it, but since you cannot escape regulation in healthcare, we wanted to kind of touch on it from the beginning there. We'll go through some legal due diligence issues and some of the regulatory issues that come up in negotiation and key transaction documents. We will look specifically at regulatory compliance challenges on both a federal and state level with a specific focus on some of the recent changes to the Stark Law. And then we will kind of finish up with some COVID-19 guidance. So let's jump in with our legal structuring considerations. And so I will go over this pretty briefly. We're going to start out with the transaction process because, the focus of this webinar really is about the regulatory issues here. But first, as you do your pre-transaction strategy, what does this really mean? It means who do you as a seller want to partner with? How involved do you want to stay in your practice? What are the issues that are going to be most important to you? It's really important to decide all of these things before jumping into a transaction process because ultimately it's a good way to evaluate whether or not you really want to sell. And if you don't really want to sell your business, then you're going to spend a lot of money in the transaction process and probably ultimately decide that it wasn't right for you to begin with. So a pre-transaction strategy is really important. The next step in this process is the transaction itself. This typically takes anywhere from 3 to 6 months. And this first bullet point here about self-diligence and housekeeping, that's not necessarily required, but we always recommend it, and it really goes to the heart of what we're considering here today. And what I mean by this is, as a seller, you want to make sure that you know your strengths and weaknesses. Are there matters where you feel that you're really strong from a corporate and regulatory standpoint? Do you have, for example, a really strong compliance program? And where are the things that you potentially are going to need to explain to the buyer? Maybe it's a repayment you've had to make over time to Medicare, a provider in the practice who's had some significant licensing issues, or something like that the buyer is going to find in the diligence process, and so it's just better to know it up front. The next is restructuring. This is sometimes, situations where a seller may want to restructure the practice or move certain assets around that they don't intend to sell or make certain tax elections prior to actually going to market. And that's, of course, just something to discuss with attorneys and accountants to see whether or not it's applicable, but just something that is a consideration. The next is going to market, and then once a seller finds a buyer, the next step is the letter of intent. And this is where you're going to negotiate, of course, some of the key terms, that must-have list, and understand your own walkaway points. So you don't get into the process and, then be surprised after you've spent a decent amount of money on the transaction that the buyer or seller is not willing to agree to something that's a complete deal breaker for you. And then you go through the due diligence process, which is where the regulatory issues that we're going to focus on are really going to come up. Sometimes we do see them, honestly, pop up in the letter of intent as well. There will be situations where maybe a buyer and seller have negotiated their own LOI between the two of them. And then when the lawyers get involved to actually start doing diligence and negotiating documents, we find that maybe some of the things that were agreed to don't quite work from a regulatory perspective. But these are all things that, you know, hopefully can be fixed once you actually get to the negotiating of documents. And as far as those goes, there will be regulatory issues to keep in mind. And, you know, some of the items that a seller thought about in that self-diligence stage will likely come up. And then finally, when it's all done, the buyer will transfer the funds and begin the integration process. So on the next slide here about DSO formation considerations, before we move on, I do just want to spend a little bit of time discussing DSOs and their formation, and because it has a significant regulatory impact, and they are something that we will discuss as we kind of move through this presentation. So a question that we receive regularly is, should I form my own DSO? And in general, you know, up on the slide here, you'll see some of the considerations that we discuss when that question comes up. But in general, forming a DSO in and of itself does not create value or get someone a higher multiple. So it requires some balancing of the specifics in any situation to come to, you know, the right determination on this question. So it's never something that we can just say, oh, yes, you should, or no, you shouldn't. It really depends on the specifics of the circumstances. And then again, on the next slide here, we have references to the basic DSO structures. And again, we're just going to touch on this because it does end up having the regulatory impact, and we will be referencing the DSO PC structure kind of throughout our presentation. So at its most basic, and we have a picture of this on the next slide, and which you'll be able to see and you'll have for reference, but a DSO is a dental services organization. And this DSO can be owned by almost anyone, doesn't necessarily need to be owned by a licensed professional. So the DSO will be owned by various investors. The professional entity, which is typically either a professional corporation or PC, or in some states a professional limited liability company, does need to be owned by licensed dentists. And that professional entity employs the dentists, provides all of the clinical services, and the dentists make all of the clinical decisions. And this is really crucial from a regulatory perspective. All of the clinical decision-making and policies need to remain with the licensed individuals. The connection between the DSO and the professional entity is a management services agreement or administrative services agreement. And that MSA or ASA, you'll hear it referred to, is the document which sets forth all of the non-clinical services that the DSO will provide on behalf of the professional entity. And this is also key from a regulatory perspective. The purely clinical side of the business needs to remain separate from the DSO, so that you don't end up running afoul of state dental practice acts. So the ASA will very clearly lay out what services and personnel the DSO will provide and what will remain with the PC. And there are a lot of the services, the non-clinical services that the DSO will provide will vary based on state law limitations, but it's going to include things like the provision of office space and equipment, the non-clinical staff such as receptionists, revenue cycle management, etc., billing and collection services, information technology, and payroll. And then down below here, you'll see also references to acquisition structures and transaction lending. Those are really less applicable to our regulatory focus today, but of course, we're happy to discuss more fully later or offline to the extent that would be helpful to anyone. And then on the next slide, like I mentioned, this is just a picture of the basic DSO structure. You can see the DSO owned by various investors, including potentially the dentist owner. The PC is owned by a dentist, and then the connection between the two entities is an administrative services agreement in exchange for an administrative fee. And so next, we're going to be moving on to some of the legal due diligence issues.
Awesome. Thank you, Anna. So for the diligence issues, we're going to start with operational issues. First, you want to figure out early on where the collateral and assets are located and consider, have held by the dentist owners or affiliated entities that need to be transferred to the practice or DSO at or prior to closing? And if so, are there any liens on those assets that need to be released? Next, you want to consider non-compete provisions that are in place in the employment agreements. You want to determine what non-competes the target has in place, have your legal counsel determine whether or not they are in compliance with state laws, and this is particularly important, especially for associate physicians, where it may not be ideal for them to enter into new employment agreements at or prior to closing. Next, with regard to billing and coding compliance, you want to consider, if you're on the buy side, when the target's last audit was. Was it an internal audit or was it a third-party audit? And whether there were any issues, and if so, if the target incorporated those suggestions. Next, you want to consider their current government and payer agreements to ensure that the target is complying with the agreements that are in place. You want to confirm that the payer contract is in the name of the dental practice, or if it is not, sometimes it could be in the name of the individual dentist, and if so, it may be tricky if that individual dentist leaves at closing. You want to ultimately diligence what processes the target has in place with regard to patient consents, especially in anesthesia and minors, as this is a highly regulated space, and you want to make sure that the target is in compliance with the relevant laws. And then
Justin,
another issue that you want to... Oh, sorry, go ahead.
One more thing on the patient consent. We see this a lot where dental offices or orthodontic offices want to post either within their office or on their social media accounts, their website, elsewhere, pictures of their patients or, pictures of their mouths or something like that. That's another area where you want to really carefully diligence the kind of consent that they have received from those patients for that, and make sure that it fulfills all of the HIPAA obligations, because that is something that we see that it's tricky for dental offices, especially smaller ones, to be appropriately following all of the obligations of HIPAA in order to post that kind of information.
Thank you, Anna. And then, no worries at all. Happy to have you jump in. And with regard to fraud and abuse compliance, that's definitely something you're going to want to look into, and we're going to discuss that in greater detail later on during this presentation. So next, I want to talk about structuring diligence issues. I briefly mentioned earlier asset and collateral locations, typically hard or otherwise referred to as non-clinical assets or owned by the DSO, and non-professionals are typically employed by the DSO. There's often a question as to whether the DSO can employ dental hygienists and assistants. We often recommend that it's either required or best practice to have the practice employ those dental hygienists and assistants, but that's definitely something you want your legal counsel to look into. Typically, the licenses and billing arrangements are also held by the practice, as should clinical assets and dental records, and collections are also typically run through the practice as well. Next, with regard to restrictions on professionals, as I briefly mentioned earlier, you should consider state regulations regarding non-compete provisions and non-solicitation provisions, and what is and what is not enforceable. Just one example, are there liquidated damages provisions? Because with regard to non-competes, there's pretty specific state guidance on what it is and is not enforceable, and which varies by state to state. Next, with regard to payer contracts, you're going to want to look out early on for notice and consent requirements for payer agreements that may be tripped by the transaction structures. We've typically seen that there can be pretty challenging advance notice requirements as far as 120 days out, and you don't want that to hold up a deal. You also want to look generally at whether a contract is favorable to the target and whether it's a contract that's worth keeping going forward. Next, we're going to talk about diligence issues specific to a dental practice. So with regard to dental board actions, licensure, and exclusion, you're going to want to diligence any ongoing risk from board actions related to the practice itself or any of the individual providers. You'll want to ask the target how often they conduct exclusion checks and have them provide a history of exclusion checks. And then you or your legal counsel should conduct exclusion checks of all the providers to make sure that they're on the OIG excluded list. With regard to Medicaid participation, you should check the Medicaid regulations and contracts, or have your counsel do that. And that is because states often have very specific rules with regard to treatment. You also want to make sure that hygienists are properly credentialed with payers, as certain payer contracts will require specific credentials for providers. And you also want to make sure that hygienists are not automatically billing their fees through the dentist if that is not appropriate under the payer agreement. So that's something that you'll want to engage your counsel on early on and have them look into for you. These are some other issues that you'd want to look into. First, you want to confirm whether the target has a bloodborne pathogen communication program and whether it is in compliance with requirements regarding training, vaccinations, and PPE. You also want to diligence whether the target's referral sources to determine whether there may be any fraud and abuse issues, which we will discuss later on during this presentation. We're also going to discuss COVID-19 concerns later on, but briefly just want to say that you should inquire early as to whether the target has taken any PPP loans or provider relief funds, as it may require some sort of consent from the lender as well as the SBA in relation to the transaction. The best practice is to start the process early on, as many lenders are still working through process issues with new and evolving guidance. And then you're also going to want to diligence whether the target has historically taken any measures in response to COVID-19, such as telehealth, social distancing, furloughs, and elective procedures, just to ensure that they're in compliance with COVID guidance and state and local government guidance.
Thanks, Justin. We had one question, too, about diligencing with respect to referral sources. And so that's a very key issue in the dental space. It is extremely common for dental offices to receive gifts or meals or other items from, different entities to which they may refer, and those are tricky because typically those kinds of arrangements will run afoul of the federal anti-kickback statute if there are federal payers involved, so Medicaid, TRICARE, etc. But even if there are not really so many federal healthcare payers, there are states that have basically all payer kickback statutes. And so we run into situations where, the provision of any gift that is intended to drive referrals can run afoul of a state prohibition. And so that is something to really carefully consider with counsel, how you want to handle that, whether it is through, the reps and warranties that you have in your purchase agreement, or whether it is through some kind of a specific indemnity. But it's something that we see pretty regularly. I think, of course, it's quite common in the dental industry, but definitely something to dig into based on the state in particular that you're in and the payer mix that you have. So that is definitely something to focus on. All right, so we're going to, now that we've kind of walked through some of the considerations and regulatory issues on the diligence side, let's keep moving through the transaction to negotiation and key transaction documents. So on this next slide, we have kind of a list of some of the core documents, and I expect that many of you are very familiar with these. So I just want to talk very specifically about some of the regulatory considerations with respect to certain of these documents. So first, I'm actually going to start with the lease agreement. And so who is the landlord in this transaction? Is it another healthcare provider, for example? Is it someone who can refer business to the professional entity? And to the extent that the answer is yes, it is generally a best practice to ensure that the lease agreement meets the applicable Stark law exception and the anti-kickback statute safe harbor. And what this really just means is, your rental rate will need to be fair market value. You're going to have a written agreement. There are certain other requirements that are set forth in those, in that exception and that safe harbor. But particularly with respect to the rental rate being fair market value, any documentation that the parties have showing how they came to the conclusion that the rate was fair market value should be retained in the parties' records, the buyer's records, just in case you ever have to show that, yes, we very carefully looked at this, we considered it, we feel comfortable that this rate is fair market value for the space that we have, and that can be done either internally or through a third party who can take a look at the comparables. Next, the continuity planning agreement. You may hear this called a lot of different names: continuity agreement, continuity planning agreement, shared transfer restriction agreement. There are several other iterations that I've heard. And as you may be aware, these agreements are documents which generally allow a DSO to remove an owner of a professional entity. And while they may be used in the event that the owner becomes a bad actor, they can actually also be used in the event that the owner dies or becomes disabled, or the parties mutually agree to add or replace the owner. And all of this being said, these kinds of agreements can create regulatory risk. There are dental boards which deem these kinds of arrangements to allow too much control and power to the DSO. So therefore, you have to be very careful about entering into them and about using them. And there are states and situations where these agreements should not be used, including, for example, New York, North Carolina. So you should absolutely consult with counsel prior to entering into these kinds of agreements, and also discuss with counsel anytime you desire to use one of those agreements, because they are tricky, and the whole goal is to have them there, but hopefully never have to actually use them. So next, we'll move on to key negotiation points. And there are issues here that need to be considered through a regulatory lens as well. So, for example, absolutely in situations where there are government payers, such as Medicaid or TRICARE, then the purchase price needs to be fair market value. Any evaluation that is conducted, again, either by an independent third party or any internal valuation that is performed by the buyer should be retained in the company's records in the event that there is ever any kind of government investigation. In the DSO PC context, the governance rights or operational control decisions do have to take into account that clinical versus non-clinical delineation of responsibility that we had talked about. There will need to be certain operational controls that remain with the providers or that require the dental practices sign off. Oftentimes we'll see things like marketing. That's one where often advertisements need to be approved by the dental practice or the dentist themselves. Another thing might be where you are determining the schedule. The schedule may need to be really determined by the actual practicing providers. But ultimately, that may be a level of control that a DSO operator isn't comfortable with. And so as the DSO, it's key that the owner of the dental practice is someone in whom the DSO has a great deal of trust and is comfortable. And just, one thing that we have really been working with clients on is moving toward having more than one owner of a professional entity, so that there is just some diversity there. And then the practice can be governed by a shareholders agreement. Finally, while escrows and holdbacks are not unusual in healthcare transactions, buyers and sellers do need to be wary of earnout provisions. While there may be certain situations where they may be very carefully structured, they're generally not widely used because they create regulatory issues in violation of federal or state kickback statutes, for example. So then moving on to just one post-closing consideration that I wanted to touch on with respect to a DSO PC transaction from a regulatory perspective before we move on is that management or administrative services agreement. And there may be state laws that will restrict what services a DSO can provide to a professional entity, which I mentioned before. So for example, the term, while it can be lengthy, shouldn't be excessive. The fee is another place where a review of state law is going to be necessary. Many states have fee splitting prohibitions, which limit a licensed professional's ability to share or split a fee with others. And so it's very common, for example, for those fee splitting prohibitions to prohibit a dentist from sharing a percentage of his or her fee with a non-professional. And so those laws will generally dictate how an administrative fee can be structured. So the option with the lower risk will typically be a flat monthly fee rather than a percentage-based fee. And we have generally already discussed the need for a DSO to stay away from clinical decision-making, which can violate state corporate practice of dentistry laws, which we will discuss in more detail just shortly. And so I'm going to turn it back over to Justin to discuss some regulatory compliance challenges.
Thank you, Anna. So we are going to start by talking about fraud and abuse challenges, and we want to start by talking about the differences between the federal anti-kickback statute and the Stark Law. So I'll start with the federal anti-kickback statute. It is not a strict liability statute, which means you do not need to meet the safe harbor. In the event that you do violate the federal anti-kickback statute, there is criminal liability for that. So we recommend that you get counsel involved early on to make sure that the arrangements, if you're on the sell side that you have in place, comply with the safe harbor or are otherwise low risk under the anti-kickback statute, or if you're on the buy side, getting counsel involved early on just to make sure that the target you're acquiring has proper arrangements in place. Safe harbors for the anti-kickback statute can be quite specific. So, for example, if you have a space lease and there is a landlord that is the dentist owner, the space rental safe harbor requires that the lease is in writing, commercially reasonable, with a rate set in advance, and is fair market value. So that's a lot to digest there, and typically just recommend that you get counsel involved early on to make sure that you're able to comply with these specific safe harbors. Stark, on the other hand, is a strict liability statute.
Justin, just to step in really briefly, for those who might not be as familiar with these particular statutes, the federal anti-kickback statute is a statute that prohibits the knowing and willful solicitation, receipt, offer, or payment of any remuneration, either directly or indirectly, overtly or covertly, in cash or in kind, in return for or to induce the referral or recommendation of federal healthcare program business between two parties. So the anti-kickback statute is definitely different because, number one, you can end up violating it on either side, either the offering or the receiving side. And it's also not specific to just healthcare providers. You know, you or I or anyone on the phone could actually violate the kickback statute in certain circumstances. And so it's definitely something that we want to take a close look at. But like you said, it's not strict liability. It's an intent-based statute. And so that way, you know, just because you don't meet a safe harbor doesn't necessarily mean that you are in violation of the statute.
Thank you, Anna. I appreciate that. And then with regard to the Stark Law, it is a federal law that prohibits physician self-referral, specifically a referral by a physician of a Medicare or Medicaid patient to an entity for the provision of designated health services if that physician has a financial relationship with that entity. So as I said earlier, the Stark Law is strict liability, so it is not an intent-based statute like the anti-kickback statute is. If you violate Stark, you're in violation regardless of your intent. So you have to meet an exception to the Stark Law or you will face civil liability. The Stark Law prohibits, as I said, referrals of DHS to an entity in which you have financial interest. Dentists are considered physicians for the purposes of Stark. Very often, the codes being billed by dentists, however, are not considered DHS, but you will need to check to make sure that the dentist does not bill DHS, as we have sometimes seen in our DSO transactions where a dentist is billing a code that would qualify as DHS. So we typically recommend looking out for billing for imaging because that is an area where you may run into a dentist that is billing for DHS. In the event that you do violate the Stark Law, there are potential refunds. And then I also want to talk about state fraud and abuse laws. We recommend that you also look into the state fraud and abuse laws for whatever state that dental practice is located in, because sometimes states can have more expansive fraud and abuse laws than the federal counterpart. For example, New Jersey has an all-payer kickback statute, which applies to all payers regardless of whether or not they're Medicaid or Medicare. So that's considerably more expansive than Stark or the federal anti-kickback statute. So as Anna mentioned earlier, we wanted to talk about some recent updates to the Stark Law. So effective January 1st of next year, a physician practice that wants to qualify as a group practice cannot pool and distribute profits from designated health service on a service-by-service basis. This is referred to as split pooling. CMS also confirmed that if there are fewer than 5 physicians in a group, overall profits means the profits derived from all of the designated health services of the entire group. So here, the group may aggregate DHS profits among the group of physicians if there are less than 5 physicians. CMS also confirmed that any physician in a practice may be paid a share of the overall profits of a group practice. The share does not need to be amongst only physician owners. So that basically means that even associate physicians can be paid a share of the overall profits of the group practice. There are other updates to the Stark Law that occur that we didn't include in our presentation that are more minor clarifications. So if you are going through a dental transaction or any healthcare transaction, you want to consult your counsel just to make sure that you're considering all the various updates. Next, we want to talk about the corporate practice of dentistry. So this is a pretty significant issue when considering how to structure the transaction and ensuring that the target does comply with the state regulatory regime. So with regard to licensure of professionals, you're going to want to pay attention to state licensure requirements. For example, some states do not allow MDs to be certified by the dental board, whereas others do allow an MD to practice and be certified by the dental board. You also want to look into what entities states will allow and not allow to form a dental practice, as that varies from state to state, which entity a dental practice can be owned by. Certain states also have what are called active practice requirements that require the dentist owners to be actively involved in the day-to-day affairs of the practice, whereas other states do not have this requirement that the dental owner be actively involved in the practice. with regard to this area, we recommend that you get counsel involved and have your counsel look into the state regulatory regimes and any court cases just to make sure that there's nothing out there that would say that this is a requirement in that state. Regardless of these active practice regulations and case law, it's always better from a regulatory perspective to have a dentist owner that is involved in the operations rather than what's known as like pure straw man, which is basically just a dental owner in name only, and it's run by the DSO. So for states without a direct corporate practice of dentistry restriction, you may want to have a deeper look into the court cases and case law that's available, and you want to consider attorney general opinions or even secondary sources for guidance. So it's not always, it varies from state to state whether a state has a very specific statutory regime regarding the corporate practice of dentistry. Some states you have to look deeper to see if there are AG guidance, court cases, or other secondary sources to try and get an opinion of what is and is not risky from a regulatory perspective in that state. Now I'm going to turn it over to Anna for the COVID-19 guidance.
All right, thank you. So another regulatory issue that we're talking about now that is new, of course, is related to the COVID-19 pandemic. And I checked, as of Friday, more than 33 million people had been diagnosed as having COVID in the United States, with more than 177 million people globally. And as all of you on the webinar are very aware, the dental setting creates a special risk of COVID-19 transmission because providers are, working in the mouth, close contact, and dealing with aerosol particles and spray. However, in general, the dental industry has done a really good job at taking steps to reduce the risks associated with dental care during COVID. So therefore, when the Department of Labor's Occupational Safety and Health Administration issued an emergency temporary standard on June 10th, which is intended to dictate the requirements that are necessary to protect healthcare workers from contracting COVID-19, there were signs that dental offices may be exempt from certain of the standard's requirements. And so I want to be very clear, it is absolutely going to vary from clinic to clinic. But OSHA did include certain exceptions in its guidance, including if the care occurs in a non-hospital ambulatory setting, if all of the non-employees are screened for COVID prior to entering the facility, and if people with suspected or confirmed cases of COVID-19 are turned away. And the website that I posted there will take you to this kind of decision tree that OSHA has provided that will help healthcare providers determine whether or not they have to comply with all of the elements of the emergency temporary standard. And so on the next slide, we have some of these requirements. To the extent that a dental office is required to comply with the emergency temporary standard, there is an extensive list of requirements that have to be met, including, for example, those noted here. There are screening and personal protective equipment requirements, providing time off for vaccination, and for employees who are dealing with any side effects of vaccination, employee training, and ensuring distance or barriers existing between unvaccinated staff. And the standard was effective immediately upon publication in the Federal Register, though they did give providers about 14 days to really get into compliance. And please also be aware that there is an anti-retaliation provision to further protect workers in these conditions. On the next slide, we note COVID-19 has also made its way prominently into the transaction process, as I am sure many of you are aware or would not be surprised to learn. There were so many statutes and regulations that popped up in response to COVID, and so it's important to ensure that sellers complied with those obligations, as well as with more general regulations that became applicable specifically during COVID, like certain employment obligations. Those would particularly come to mind. So one of the things that we want to understand when we're diligencing a practice kind of, as we enter the post-COVID period is whether the seller received any COVID-related funding, such as the Small Business Administration's Payroll Protection Program loans, or anything from the Public Health and Social Services Emergency Fund, which you might have generally heard of as the Provider Relief Fund. I expect that many of you are very familiar with PPP loans. One regulatory issue to keep in mind in the transaction process today is how to handle these loans in a transaction. So in October of 2020, the SBA finally released guidance that keyed to a change of ownership of the PPP borrower. Prior to that guidance, there had been confusion about the steps that an entity that received a PPP loan needed to take if they were going to go through a transaction. So now, generally, a transaction is exempt from obtaining Small Business Administration consent if certain obligations are met. So, for example, in an asset sale of 50% or more of the borrower's assets, the borrower must complete the PPP loan forgiveness application, reflecting its use of the loan proceeds, and submit that to its lender, and then also put into an interest-bearing escrow account with that same lender funds equal to the outstanding balance of the PPP loan. And this has been a bit of a shift as lenders and borrowers try to figure out this new process, and we still see some confusion on the part of lenders in connection, particularly with the second round of PPP loans. So I think Justin already mentioned this too, but just really want to reiterate that my biggest transaction tip on this would be to start a dialogue with the lender very early on in the process if the target's PPP loans have not all been forgiven. We've had situations where a lender, even just recently, has said that the portal for submitting a second round PPP loan forgiveness application isn't open. So they just simply can't do anything. And the lender itself was not aware that you had to submit the forgiveness application and set up the escrow in order to avoid obtaining SBA consent to the transaction. So it's definitely something to start working on very early on. We had another lender in a transaction recently who basically said that it was going to take them 4 weeks to set up the escrow account, even though the forgiveness application had been submitted. And unfortunately, the seller in this particular instance hadn't really raised it or pushed it with the lender until we were about a week and a half out from closing. And so that put a huge wrench in the whole process. Also in July of 2020, the Department of Health and Human Services announced that it would allow dentists and other dental providers to apply for relief from the Provider Relief Fund, which was extremely appreciated by dentists because it was the first time that the Provider Relief Fund distributions were designated specifically for dental providers because they really hadn't been eligible for any of the prior distributions. Now, in general, so long as the dental practice was eligible for and met the requirements to apply for and receive money from the Provider Relief Fund when they applied, and so long as the practices used or are using the money for an approved purpose, like replacing lost revenue attributable to COVID, then there shouldn't be an issue in connection with this money and a transaction. But that being said, the practice should ideally still be operating when it receives the money, which shouldn't really be an issue any longer. And the funds need to remain with the practice. So the Provider Relief Fund money should not be transferred to the buyer. Parties should also be aware that there are audit obligations in the event that a provider receives more than $750,000, which probably isn't the case for most small dental practices, but larger groups may have that be applicable to them, and those audit obligations may be quite burdensome. It was actually just announced that healthcare providers will have 90 days beginning July 1st, 2021 to report on provider relief funds that they received in the first half of 2020. And it was confirmed that the funds received in the first half of 2020 must be used by June 30th, 2021. So we finally have some certainty around the provider relief fund program's next steps. And this probably, again, because the fund was available to dentists so much later on, this probably won't be so applicable to dental providers right now, but it's something to keep in mind as we start to move toward reporting periods that will be applicable to the time in which the dental providers started to receive them. Teledentistry, telehealth has been on the rise during COVID as a way that some dentists were able to still address patient needs during their office closures, or in general when patients may have been, or some still are, continue to be leery of coming into the office. And this really had the potential to help offset some of the losses from reduced in-person visits while still being able to provide necessary patient care. However, from a regulatory perspective, buyers need to be very aware of what teledentistry platform the sellers have been using, and otherwise ensuring that patient privacy is maintained, because there could end up being significant data privacy risks here. And even just from a very basic perspective, just making sure that there is a business associate agreement with that telehealth provider, just as, kind of bare minimum. Excuse me, bare minimum of what we need to see, while we also are kind of diligencing what that relationship looked like. Was there or should there be changes to dentist employment agreements? Did any dentists see a reduction or delay in their compensation payments? As the buyer, be sure to review these arrangements really carefully with counsel, because it could be that a seller agreed to make up those compensation payments at some future point. And so the buyer doesn't want to be on the hook for those obligations. This really actually ties to the last point on this slide too, about rent abatement agreements. Were there any agreements to decrease rent for some period of time, but then have to add it on to future rental payments? Or was there an extension of the lease, or any obligation to, continue paying longer beyond the lease term? And is that something that the buyer is comfortable with? Because in the end, again, buyer doesn't necessarily want to end up with higher rental payments than it was expecting for a period of time in which it did not own that practice. So it's definitely something to keep in mind and to diligence. Were there any other defaults under or terminations of any agreements as a result of COVID? As you probably can imagine, force majeure clauses in contracts have become particularly important. And so, but to the extent that there was a really important contract that was terminated during COVID because one party or the other couldn't comply, that's definitely something that a buyer wants to understand, particularly if the breach was on the part of the dental office that it's acquiring. Many practices also took steps to furlough or lay off employees during the pandemic, and employers, as I'm sure many of you are very aware, faced additional requirements under COVID-related laws like the Families First Coronavirus Response Act, which provided employees of certain employers paid sick leave or expanded family and medical leave for specified reasons related to COVID. And so when you're looking at the way that these regulations will affect the practice and the diligence process, so in connection specifically with furloughs, it's important to confirm whether the practice did furlough any staff and how it was conducted. Was everyone called back? If certain individuals were not called back, why were they not called back? Was there any discriminatory purpose behind these decisions? Were the furloughs done across the board, or were there any targeted furloughs? We were doing diligence on one practice, and this actually wasn't in the dental space, but it was in the medical space, and we were informed that, when we asked, of course, that, well, they had brought everyone back except an employee who was pregnant. And so all of a sudden we had a potential discrimination issue on our hands that we had to dig into further. And so that's the kind of thing that you want to be on the lookout for. Did the practice confirm, especially if it's a larger practice, that any WARN Act or State WARN Act notices were required? While some states had suggested that COVID layoffs didn't trigger their state WARN notices, it's not guaranteed. So if this was an issue, you just want to take a closer look. Were there any reductions in salaries for salaried employees? If these were handled inappropriately or if the cuts were really severe, you could also have issues with respect to exempt status. And any reductions for independent contractors or other salaried employees should have been acknowledged and agreed to in writing. With respect to the Families First Coronavirus Response Act, the other thing we're looking for here is to ensure that the practice followed the rules if it was applicable to them, and to confirm whether or not anyone took advantage of the program. So the buyer should ensure that the practice works with an accountant to confirm that it received the appropriate tax credits and handles them appropriately as well. And then finally, as we note here, COVID has popped into indemnification provisions in certain circumstances, and we absolutely see matters related to the CARES Act and other regulations also show up in the definition of excluded liabilities, so that the buyer can at least try to leave that liability behind with the sellers. So as you can absolutely see, COVID really has had a pretty significant regulatory impact on how we diligence transactions. And so, these are all things to kind of be on the lookout for and be considering and to ask the questions about. And then I think we have just a couple of other items, Justin, that you were going to run through.
Yes, that's correct. So a couple additional items that you're going to want to look into when you're acquiring a dental practice is there are policies for HIPAA, and it's important to diligence targets compliance program and its specific policies and procedures. That's how often it does training. Does it do it on hiring, or does it do it annually? The extent of the training, and whether they do training internally or have it done by a third-party vendor. We're also going to want to ask, do they store any information offshore? Have there been any past data breaches or any data privacy audits? As for marketing, you're going to want to look out for specific coupons or discount programs, because those would present risk under fraud and abuse laws. That's something you're going to want to look into. And then next, DBA requirements. Some states have doing business as requirements that you should look out for. For example, can you use DSO branding, or do you need to use the dentist owner's name? That's a specific issue that you're going to want to look out for. And some states restrict marketing as it pertains to the corporate practice of dentistry. Best practice is to give the practice approval rights over all marketing materials, but also to have legal counsel make sure that all marketing programs are in compliance with board regulations, as guidance can vary from state to state, and you're going to want to have your counsel confirm that the marketing procedures comply with state law. Finally, we just have one slide about the registration of DSOs, and basically the main takeaway here is that there are a handful of states, such as Texas, that require DSOs to register with the Secretary of State. I want to save some time for questions, so I won't go into all the details here as we're going to provide the slides to you, but this is just another thing that you're going to want to look into and get your counsel involved in early on to make sure that if you do need to register, you're looking into that process early on and making sure it doesn't hold up the transaction. With that, I'll open up for any questions.
So I know we have a question about whether a DSO's clinical composition of a board or equity ownership matters when considering the level of regulatory scrutiny or risk involved. In other words, would risk be lower if a DSO is run by a board of clinicians or owned by dentists? So the short answer is probably, but it's caveated because in the end, the DSO cannot do clinical things. And so even if you had a DSO that was comprised of entirely of dentists as the owners, if that DSO was employing clinical staff or, you know, as a non-professional entity, or it was, you know, handling all clinical decision making with respect to, you know, how to schedule patients, what the patients should be asked about, certain marketing activities, things like that, it's still going to be prohibited. Another example would be, just for example, Colorado. They don't allow, in this kind of DSO-PC relationship, they don't allow the DSO to lease the real estate and then to sublease it to the practice. So, you know, regardless of what your DSO membership was comprised of, if the DSO was doing that with a practice, that would still be prohibited. But all of this being said, the fact that the DSO is run by dentists probably is going to raise a little bit less scrutiny by a dental board, because in the end, so long as those individuals are, you know, kind of also involved on the practice side in particular, or at least licensed in the state where it's providing services, you know, you are clinical decision makers who, you know, likely are going to raise less of a red flag to a dental board. But there's still definitely a very serious line that needs to be upheld between a DSO and a PC, kind of regardless of the DSO's ownership. We have another question about whether compliance is less stringent in a single practice compared to a DSO. The answer is no. In the end, the same things that a practice has to adhere to from a regulatory perspective, if it's a practice of one provider versus a practice of 50 providers, is the same. You have the same HIPAA requirements, the same licensure requirements, all of that. What is different is that, of course, the larger you are, the more of a target you become. And so that is absolutely, you know, something to keep in mind. The difference between a practice versus a DSO, typically the compliance, you know, strictly compliance, like we might think of, you know, like I said, maintaining HIPAA policies and procedures and that kind of thing, that is specific to the covered entity. As a business associate, for example, the DSO has different obligations. So the regulatory requirements on a DSO are just very different from what you would see with respect to a practice. That being said, everyone has to comply with those fraud and abuse rules that Justin was discussing, particularly the kickback statute, where it doesn't matter, you know, kind of who you are. So those are the kinds of things that you have to kind of keep in mind there. And then we have one other question about whether multiple practices which have separate EINs are considered a DSO when it's not structured like that, and the answer to that would be no. You structure a DSO separately, and so that would be something that would have to be set up. So you wouldn't default to that. All right, I think we have hit the top of the hour here. We wanted to thank you all so much for your participation today. We hope that you found it useful. And if you have any questions, please do not hesitate to reach out to us, and have a wonderful afternoon.